So today I'll be talking about DeFi, and I think the target audience will be really those who don't really understand DeFi. Being an educator by trade, I'm a lecturer at UCL Centre for Blockchain Technologies. I teach blockchain technologies and machine learning in machine learning finance at UCL for a few MSc programs. I'm also the program director for MSc Emerging Digital Technologies at UCL. So yeah, again, the target audience for this presentation is those who don't really understand the mechanisms of DeFi applications. So I'll be going through a few common DeFi applications, including AMM-based DEX. I'm just using acronyms right now, but you'll see what they really mean in a minute. Lending protocols. What else do we have? Yield aggregators and decentralized insurance solutions or token-based insurance solutions. So yeah, my current research interests lie in DeFi mechanisms, the economics of decentralized finance, security, privacy aspects of DeFi. I might not sound as enthusiastic as the previous presenter. After knowing like how exactly things work, it's so sorry if I do not sound very enthusiastic, but I like to dig things deep and see things through. So today I'm here to kind of debunk the mysteries of decentralized finance and show you guys the different components of different decentralized finance applications and the mechanisms and flows of different DeFi. Okay, great. The slides are up. So what is DeFi? Jason. DeFi, decentralized finance. Quick definition here. Although you might know already, it's a rule-based financial system that operates according to protocols composed of smart contracts on blockchain. I think you probably do not need me to explain what smart contracts and blockchain are already, although it is. Let me go back real quick. Yeah, although there are different definitions out there. Anyway, with blockchain, how do you really define a blockchain? Is it just like a chain of blocks of data? And what really is a smart contract? How do you define that? But I'm not gonna go too deep into that. Just protocols for those who are not super technical and don't really speak the DeFi language. Protocols are really just a set of rules. So those are kind of synonymous. Rule-based protocols, well, it's really just a set of rules that define how things work. So decentralized finance is a rule-based financial system operating based on protocols. Next. So some logos here to show the most commonly seen DeFi applications. As said, we have DEXs or AMM-based DEXs. I call them decentralized exchanges, acronym DEX. Here, what I show are all AMM-based DEXs. AMM stands for anybody? Actually, I'm just gonna. Thank you. Okay, you know already. You're probably not my target audience, but really, yes, automated market maker, automated market making algorithm. Of course, there are other order book-based decentralized exchanges as well, such as DEXs running on the XRP ledger, so on and so forth. So so what I show here, Uniswap, Balancer, Curve, and Dodo, those are automated market-making based DEXs, and they operate based on the exchange rates are always automatically calculated based on this function that we call conservation function or bounding curve. And then we have lending protocols. Here are a few common actors. You will see MakerDAO. It has this stable coin. All of you probably have heard. It's called DAI. It's kind of like a lending, borrowing, algorithmically determined or pegged stable coin. That's one-to-one pegged, soft pegged to US dollars. And then we have Compound and Aave. They work kind of similarly. We'll have a look into that later. Yield aggregators. We have Yearn Finance, Harvest Finance, Pickle Finance. That's for yield farming. That was very popular last year. Token-based insurance solutions. Here I listed Nexus Mutual, EtherRisk, Insure. Those are probably less commonly known than the other DeFi applications. And indeed, insurance applications are still evolving and indeed less mature than the other more commonly seen DeFi applications here. Next. Am I blocking you guys? If you have questions, please feel free to interrupt me. So yeah, DEX with automated market making or market maker protocols. They use a so-called bonding curve or conservation function that determine exchange rates between crypto assets algorithmically. If we can go to next slide, I have a quick stylized AMM mechanism that show you the core actors, user actions, and state of pools. Well, they can all be represented, all those little actors and pools, they can all be represented by Ethereum addresses. So, well, an actor, you have a corresponding Ethereum address as your kind of on-chain ID, and a pool, liquidity pool, it's really just a smart contract that has the ability to hold assets. So every single pool has a corresponding ID, which again will be its address. On Ethereum, it will be its Ethereum address. So here we'll see that in the AMM-based DEX, you will have liquidity providers who will be providing liquidity, deploying liquidity into a pool. And for exchange users with AMM-based DEX, instead of matching a buyer and a seller, you do not have to find the kind of your trading counterparty. You are basically, as an exchange user, you're basically trading against or with the pool. So, well, ultimately, you're actually trading against the liquidity provider who provides liquidity into the pool. But yeah, you're trading with the pool. So, which is why AMM-based DEX is always advertised to have this feature that we call continuous liquidity, because later we'll see that you will always be able to make a trade, unlike with order book-based exchanges, where you have to match a buyer and a seller. If you cannot find your kind of exchange counterparty, your order will sit in the order book until it gets consumed. Okay, so what we have here, just real quick, liquidity provider. Yeah, liquidity provider, when they provide liquidity, they'll get something that's called liquidity shares that represent the ownership of the pool. And then when they withdraw, they can freely withdraw their liquidity that's provided into the pool as well. And then when they withdraw, they have to kind of redeem their liquidity provider shares. Exchange users, they use this whole pool contract to conduct crypto asset swapping. So yeah, conservation function, hope it's not too overwhelming, but the basic idea is that when you trade against the pool, what you specify is not, unlike order book, you would specify the quantity of both sides. So you say that I want to buy, let's say, 1 BTC for 50 grand, for example. You will specify 4 things. So the selling asset, the buying asset, the selling quantity, and the buying quantity. 4 variables. When you are interacting with AMM-based DEX, you specify only 3 variables, and the conservation function will automatically calculate the 4th variable. So basically, it's calculating according to the curve, such that the combination of reserves, the reserve liquidity in the pool always follow this kind of bonding curve. Not going to go too deep into that, but we can go next. Yeah, and I showed like 4 different logos at the very beginning. So we have Uniswap balancer. What else did I show? There's Bancor as well. I don't think I showed Bancor. Uniswap, balancer, curve, and Dodo. They all use different types of conservation function. This one is really the Uniswap conservation function, what we call constant product conservation function, because the product of the reserve quantity always stays the same. Lending protocols, again, as said, in a similar vibe. DEX will calculate your kind of exchange mechanism based on a set of rules. Lending protocols, similarly, it conducts lending and borrowing also based on a set of rules. Here with lending protocol, especially the particularly interesting bit is the interest rate model. So yeah, DeFi lending protocol, we also call it protocol for loanable funds, or PLF. It uses smart contracts to manage deposits, borrows, and also distribute charge borrow interests, and distribute lending interests or deposit interests based on a pre-programmed interest rate model. What is really interesting to differentiate between lending protocols, DeFi lending protocols, and centralized lending marketplaces that we see with like banks and other kind of lending companies out there in the centralized world or conventional financial world, is that in the conventional financial world, lending or borrowing is usually credit-based. So basically, if you want to take like a consumer loan, if you want to buy an iPhone and you want to pay in tranches instead of paying all straight away, all at once, then usually what's going to be checked is your credit history. Whereas in the DeFi world, you don't have a credit history. So what do they do? Well, what they do is that the lending mechanism is completely collateral based. So to make sure that the depositors' funds are safe, all the borrow positions must be over collateralized. So there's collateral, and then there is this automatic liquidation mechanism, which specifies that when the loan to value ratio exceeds, because of market movement, so when the loan to value ratio exceeds some kind of critical threshold, what we call the liquidation threshold, then the smart contract would automatically trigger this liquidable status of the borrow position, such that your collateral will be listed for auction for bidding, and any network participants can purchase your collateral with some liquidation incentive, with a discount, by repaying part of your loan. Such that the depositors' funds will always be protected. That's that. Next. Yeah, so just a quick example of some interest rate models. So you'll see that this is interesting. This is the interest rate model from Compound. The interest rate is both lending and borrowing rates are positively correlated to this variable called utilization ratio, which is the ratio between borrowed funds and deposited funds. So you can see that if you have extremely low utilization ratio, what does that mean? That means that you have a lot of deposits but very little borrow. That means that the capital efficiency is quite low. So what they do is that they have, here you have extremely low interest rate for both borrows and for lends. That encourages people to borrow because the borrow interest rate is very low, and it discourages people to lend because they're not interested in lending because the rate is so low. So when that dynamic happens, it moves the utilization ratio along this line such that it hits this kind of kink. Once it gets to this optimal kind of ratio, both rates will go exponentially high. Why is that? So as here you can see that that's when the borrow rate, the utilization ratio is very high. So when the utilization ratio is very high, the lending pool, again represented by a smart contract, is in the danger of being depleted. So when that happens, you have very high interest rate, borrow interest rate, and very high lending interest rate, such that lenders are encouraged to deposit more, borrowers are encouraged to repay more, such that they don't accrue interest that quickly. So it's just gonna swing back and forth within this sweet spot. So the sweet spot that they identified is 80% of utilization ratio. So that is also kind of pre-programmed in the smart contract, such that you don't have to do the calculation yourself. It's all calculated automatically by smart contract by looking at its deposit and lend quantity. Sorry, a deposit and borrow quantity. Yeah. So again, a stylized scheme here. I don't think I'm going to go too deep into that, but just that there are different actions there. Mint is really to deposit, because when you deposit, you are basically minting a token that's like an IOU token. It's like when you deposit in a bank, your bank is going to show that you deposit 10 grand in your bank is going to show you have 10 grand in your bank account. That's what we call e-money. Similarly, when you deposit in a smart contract, the smart contract will return you with some kind of token. If it's compound, it's going to give you some C token. If it's Aave, it's going to give you A token. That's the certificate of deposit. And then redeem, that's the opposite. Liquidate, we have talked about. Repay, borrow, I'm not going to go too deep into that. I think I've already spent too much time. Next. So not every crypto kind of lending scheme or any lending scheme related to crypto can be called a lending protocol. Here I have a map, x-axis. You have fiat money, crypto asset, decentralized, centralized. On the upper right, you have central bank, very centralized and dealing with fiat money. Here on the other side, decentralized, only dealing with crypto assets. Those are the DeFi lending protocols. Somewhere here in the middle, we have CeFi crypto banks. That's where you can actually deposit your for example, ETH or Bitcoin, and then you can get some fiat back. So it's a mix of fiat and crypto, but those are not lending protocols. They do not operate completely automatically in a decentralized fashion, unlike DeFi lending protocols. Next, yield aggregators, just real quick. Yield aggregators is what I call decentralized fund managers that use smart contract to determine and execute investment strategies. So you have so many lending protocols. They have all different interest rates, and now a lot of protocols also give you kind of incentive to participate in the form of governance tokens. So what would be the best DeFi investment to make? If you do not know, the most efficient way might be to deposit in the yield aggregator, and they will figure it out for you automatically. It also saves gas, as we know that I think before we have this layer 2 solution, the gas fee on Ethereum is extremely high. So if you are a retail investor and you do not have a lot of funds to play with, sometimes you end up with having more funds to having less funds to invest than the gas fee that you have to pay, which is kind of ridiculous. So with DeFi aggregators, yield aggregators, you kind of just have to do the transaction once, and then they aggregate all the funds together and then interact with the complex smart contracts on blockchain. And if you know some basics of Ethereum blockchain, how the gas price works, you would know that the more complex a smart contract is, the higher gas fee it will be. So it will be more, it's not proportionate to the quantity of funds that you play with. It's proportionate to the computation that the network has to conduct. So it will be more efficient to pool the funds together. So that's why also yield aggregators make sense. Yes, next. Yields come from different sources. Borrowing demand, as we said, some kind of deposit interest by interacting with lending protocols. And then we have liquidity mining, which is really when you deposit, or when you interact with some protocols, you get newly minted protocol tokens as some kind of incentive. That's what we call liquidity mining. Revenue sharing, when you operate as a liquidity provider, you get some kind of transaction fees on decentralized exchange. Yield farming process, I think I've covered most of it. Farmers, those are yield farmers. So users interacting with yield aggregators. And then I'll just go through this easy route. They'll deposit, and then into a pool that aggregates funds. And then the pool itself, the smart contract, will execute some kind of strategy, and then so on and so forth. It's a cycle. Next. Yeah. Token-based insurance solutions, also very interesting. Again, rule-based. They use smart contracts to hold premium payments, distribute payouts, and manage risk assessment. Yeah. Last. Yeah. So this is just a landscape of token-based insurance kind of scheme. You have here insureds, claim assessors, reinsurers. Those are usually risk-seeking investors. Risk assessors, underwriters, and the DAO that would govern the protocol, making decisions on which risk to kind of include, which risk not to include, and their say is proportionate to their token holding. I think that's it. Yeah, the last one was a bit rushed, but if you have questions, I'm more than happy to answer. Oh, can we show the final slide? Yeah. Yeah, those are all based on kind of research book chapters and preprints, research articles. So if you want to read more about the mechanisms, also vulnerabilities, risks associated with DeFi applications, feel free to have a read and reach out to me. That's all. Thanks.
Thank you, Dr. Jiahua Xu, and